So looking at the estimates right now, headline CPI is forecasted to rise by 0.4%, year-over-year inflation 6.2%. What does that mean for the markets, and what does that mean for the Fed?
Well, the good news is that it's cooling. The bad news is that it's still too hot for the Fed. This is not the porridge is just right in the Goldilocks scenario, and I think that's the most important message. And we've already seen that with the revisions to the seasonal factors. Back in the fourth quarter, we saw that inflation ended the year with more momentum than the Fed liked, especially in core inflation. And I think that's very important. There was this sort of sense that maybe we could get to this soft landing without the Fed having to go too far, with inflation coming off more rapidly. One thing the Fed has always pushed back on is that this is a marathon, not a sprint. And in fact, the push from getting inflation from that 9.1% peak we saw in June down to 6.5%, and then down to sort of 4.5% range. That was going to be the easy part of it. The hard part of it was getting it so that, especially at core level, was no longer distorting our decisions and back to the 2% range. Now, in the CPI, that's a little warmer than that, but still, this is a tough slog to go from where we're at down to inflation not being a big influence on all of our decisions.
Yeah, I mean, inflation, obviously, again, as I mentioned before, kind of the theme of last year. I want to talk to you about a pause or a pivot and the possibilities. I'm not going to keep the alliteration going, but a lot of people took Jay Powell's comments, I believe it was last week, as a sign that the Fed may be shifting its strategy. Did you read it that way as well?
I think that there is a lot of optimism that the Fed may be in the process of thinking that, but I don't think that's what's going on. I mean, he stuck to the script in terms of, we're going to stay the course, and that they still see doing too little in terms of rate hikes as a greater risk than doing too much. And I think that's unfortunately where we're at. And given the revisions that we've seen to the CPI data and the seasonals, that, it was a bit of a head fake that we saw as much cooling as we did. That confirms to the Fed what they're worried most about, and that's hitting too high of a floor on inflation and getting a more persistent inflation, and one that could have a second wave if we have any other supply shocks out there. We've had a lot of good luck recently to get rid of some of the supply shocks that were in the pipeline. It's not that far, though. We've got very tight oil inventories. It wouldn't be hard to have another supply shock that could push things back up. And like I said, getting inflation really down to the point that it's derailed and no longer part of our decisions. That's the Fed's goal, and we're still not there.
Yeah, those oil inventories, definitely an interesting data point, especially with China still in the process of reopening, not quite reopened just yet. So we focused a lot on CPI and PCE, metric reports that give us inflation data. But what about some of the other economic reports out there? I'm talking about ISM. Of course, last week we had the jobs report, huge blowout number. What are you making about what you're seeing out of those different reports, as well as when it comes to mortgage rates?
What's been really interesting is, the ISM services index was actually strong, where the manufacturing sector is showing declines. And so we're seeing all these mixed messages out there. And what it is an economy, sort of a tale of two economies in many ways. Where there are inventories, we're having to see discounting by retailers. On the other side of it, in the service sector, we're seeing that vacations just don't end. In fact, they've got a new word, I think it's called Blakations, where people take business trips and turn it into a vacation. In fact, travel during the month of January, those people out on vacation outnumbered those on a seasonally adjusted basis for December, which was the highest December on record. So we really are seeing a very big shift into services, and that is changing the dynamics of the economy. Coming out of the pandemic-induced bubble in housing, now seeing mortgage rates go back up a bit. That could cut off housing again. It was also interesting that one member of the Fed at least was worried that mortgage rates too low could mean that housing prices don't cool enough and rents don't cool enough to bring inflation down going forward, making their job even more difficult. So there really is a sort of sense of they really need to push a little harder, get a little further on those rate hikes. And I think the error on the Fed is going to go higher rather than lower on rate hikes. We could see the Fed talking about more than 5.25%. We already had a lot of people whispering about that last week within the Fed system.
Well, I'm not going to whisper about this. Blakecation, my new favorite word. I hope it replaces transitory of the word of this year. KPMG's Diane Swonk, thank you for being here.